It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader in less than 5 minutes per week. The video newsletter is brought to you by TradingTips.com.
Welcome to this video newsletter on RSI, Relative Strength Index, how to interpret and use this valuable technical indicator. In this episode, you'll learn how to read and understand a stock's RSI, and how to use RSI to predict a trend reversal. Let's begin. First, what is RSI? Well, it is a momentum oscillator invented by J. Wells Wilder in 1978. Back then, finding a stock's RSI was difficult to do. The calculation is pretty complex. But now, you can find a stock's RSI in Yahoo Finance and most other financial websites. The purpose of RSI is to measure the velocity and magnitude of a stock's price movements. This is done by comparing the exponential moving averages of the stock's up days, days on which it closed higher than the previous day, with the exponential moving averages of the stock's down days, days on which the closing price was lower than the previous day's close, and standardizing the number on a scale of 1 to 100 so it's easy to read. Knowing this information can help you see when a stock is overbought or oversold and due for a reversal. Generally, a stock with an RSI of 30 or lower is thought to be oversold and due for an upswing, while a stock with an RSI of 70 or higher is thought to be overbought and due for a correction. Of course, stocks can have low or high RSIs for several days before reversing, which is why it's important to know two other methods for interpreting RSI: bullish and bearish divergence, and failure swings. Let's look at each of these individually. The theory behind RSI divergence is that a stock's RSI should conform to its price action. For example, if a stock hits a new high, then its RSI should also be at a new high. And when the stock hits a new low, then the RSI should also be at a new low. When these things don't happen, there's divergence. Bullish divergence is when a stock hits a new low, but its RSI doesn't hit a new low. This indicates the stock is likely to rebound. Bearish divergence is when a stock hits a new high, but its RSI does not hit a new high. In this case, the stock is likely due for a correction. Another theoretical tool for interpreting RSI is the concept of failure swings. Here we are looking for stocks with RSIs under 30 or over 70. If, for example, a stock's RSI breaks 70, pulls back, and then recovers to go higher, then when the RSI next falls below the pullback level, this is considered a failure swing, and usually a sign that the stock's trend is about to reverse. Let's look at an example. On this chart, the stock began a bullish run on April 28, with its RSI first breaking 70 on May 4. The stock and its RSI continued to climb for several days, until both finally faltered on May 7, pulling back to 64.8. Now at this point, if the RSI continued to fall the following day, there would be no failure swing. If, however, the RSI went back up the following day, which it did, then the key level to look out for would be 64.8, the original pullback level. When the stock's RSI next fell below 64.8, there'd be a failure swing. The following day, the stock did bounce back to a higher RSI. In fact, the stock price hit a new high, but the RSI of 72.92 was not a new high. It had hit 74.51 on May 6. The new price high without a new RSI high indicated a bearish convergence. The following day, the stock retreated, as predicted by the bearish convergence. What's more, the RSI fell below the key level of 64.8 to 61.36. Now the stock had a failure swing in addition to a bearish convergence. As you can see, the stock fell considerably over the next several days. Traders who knew how to read and interpret RSI were able to get out of this stock or even take up a short position ahead of these declines. To recap, RSI is a momentum oscillator that measures the velocity and magnitude of a stock's price movements to help inform you of potential pattern reversals. RSI is measured on a scale of 1 to 100, with the key levels being 30 oversold and 70 overbought. Divergence occurs when a stock hits a new low or high without a corresponding RSI low or high. A failure swing occurs when a stock's RSI hits one of these key levels, retreats, quickly returns to its previous trend, and then falls back to the pullback level. We hope you've enjoyed this video newsletter on Relative Strength Index. Thank you and have a wonderful day.
This Trading Tips video newsletter has been brought to you by Manny Backus's First Hour Trading System. Every day there's money to be made in the first hour of stock trading. This is the world of day trading, not for novices, unless you have a system. The First Hour Trading System. Visit firsthourtrading.com now and sign up for a free 30-day trial. You could make enough in the first hour of your day to take the rest of the day off. Do you want to view more Trading Tips videos? Visit tradingtips.com. Sign up for our free video newsletters. Become a successful trader by visiting tradingtips.com.